Hello, I'm Nick Axford, CBRE's Head of Research for Asia Pacific, and joining me today to talk about the New Zealand market is Zoltan Morris, our Head of Research for New Zealand. Hi Zoltan, let's start by having a look at what's happening in the economy.
Hi Nick. The economic activity points towards a tale of two cities in New Zealand with diverging trends between Auckland and Wellington. These have been influenced by the relative positions of the two cities, with Wellington being center of government and Auckland being the center of commerce for the country. And the cyclical upswing in the economy over the last 2-3 years has been benefiting the Auckland property market, but at the same time the government austerity measures have been constraining Wellington. The chart is showing the office vacancy trends for the CBDs of these two cities, clearly indicating the improvement in Auckland and the continued increases for the Wellington CBD office market. But these broad trends are also evident across the industrial and retail sectors as well. So it's a fairly universal indicator of the relative performance of those two cities. Moving forward, economic drivers point to modest growth for the New Zealand economy during the next 2-3 years. So the recovery that has commenced back in 2010 is expected to strengthen somewhat. And the main drivers behind that, well, there will be twofold. One is the Canterbury rebuild after the earthquakes, which will contribute up to about $30 billion to the overall New Zealand rather than just the Canterbury economy during the next few years, which accounts overall for about 20% of the country's total annual GDP. So it's going to be quite a significant stimulus. And the other major feature that will be driving the economic recovery is the housing market, which after stagnating in respect to new construction, has started to become more active, especially in Auckland, and the recovering housing sector, both in terms of values as well as development construction activity, should flow on to a reasonably broad-based recovery across both the consumption and the investment sectors. Some of this will also benefit Wellington as well, especially if that entrenched economic recovery will translate into a shift in government's focus from the current cost containment strategy towards a more expansionary government spending program over the next few years. And we expect that these underlying conditions will underpin a continued recovery of the occupier markets, both through positive absorption, an improvement in the vacancy rates across the Auckland markets, and hopefully a peaking of the Wellington vacancy rate and a turnaround into more positive occupier conditions towards the end of this forecast period.
So that suggests that the demand side is looking reasonably healthy. What about the supply side of the market? Is there much under construction?
Well, the supply side is reasonably subdued over the next few years. Again, just showing the CBD supply cycle for the next 3 years. Well, there's two things that are evident. First of all, in both cities, we had supply cycle peaking during the recession, which contributed to the vacancy increases that you have seen previously. But looking forward, in both of those cities, we only expect about 1.5% of the existing stock being added to as net supply during the next 3 years. So the supply outlook is quite minuscule. And the positive influence, apart from a low level of overall supply, is the fact that we're going to be seeing some withdrawals of existing stock. So there's going to be some periods of negative supply coming through, which is resulting from the withdrawal of some existing buildings, usually buildings with quite significant vacancy overhangs. Some of this will be removed permanently for change of use, and some of it will be temporarily. And will be coming back as refurbished stock, especially in the case of Wellington around 2015. But in the short term, the supply cycle is actually benefiting vacancy rates, not just through the lack of new construction, but through the withdrawal of vacant existing stock.
So that sounds as though it should lead to an improving outlook from a rental point of view and potentially even some rental uplifts over the course of the next couple of years?
Yes, that's what our expectation is. In terms of effective rents, we have seen some improvement already across the Auckland markets, as some of the incentives that were offered during the last 3 years have started to come out of the market during the past 12 months or so. And in Wellington, there has been some isolated cases for buildings with favorable seismic performance of rental growth. But as the occupied market stabilizes further and vacancy is brought under greater control, we expect that some of these trends will become more entrenched. So initially, we expect a reduction in incentives and an increase in effective rents through that. And for that trend to flow into effective rental growth through the headline rents increasing as well, rather than just incentives being withdrawn.
And we've been suggesting for a while that the Australia and New Zealand markets look relatively attractive from an investment perspective in an international context. Do you think that this sort of improvement in the occupational market outlook will feed through into confidence from investors?
Yes, I think so. We're already seeing that manifested itself in closing of the yield gap, especially during the last 9 months or so. The investment sector has become a lot more dynamic as investor confidence has improved on the basis of the improving fundamentals that have started to manifest themselves. So there has been greater investor confidence and less risk aversion for physical property. And some of the factors that have been driving the investment market in New Zealand also is the relative gap between funding costs as well as returns from alternative asset classes. So physical property has been increasingly attractive during the last 18 months from a number of perspectives for investors, and over the last 6-9 months, that has resulted in quite a firming of market yields across most sectors, and in most cities as well. Even in Wellington, for stock that is meeting occupier expectations, we have seen quite a decent firming in yields in the order of about 50 basis points or so.
And the pickup in investment activity as well.
That's right, and that has been leading to quite a lift in investment activity compared to the last few 6-monthly periods. The second half of 2012 have seen about a 75% or so increase in investment activity. And this is from a wide base of investors as well. Initial focus at the beginning of the recovery has been from private domestic purchasers, but during the last 12 months, that has broadened significantly to include both offshore and onshore institutions, with investors from Europe and Asia increasingly focusing on New Zealand, as well as domestic institutions, and the private investors are continuing to play quite a strong role as well. So there's a broad, strong base of interest, and we expect that to continue into 2013 as well, given some of the larger portfolios and some of the large individual properties that have recently come on the market or are expected to come on the market during the next 6 to 12 months.
That's great. Thank you, Zoltan. That's all we have time for now. There's obviously a lot more detail behind that analysis of the New Zealand market. If you are interested, please do feel free to visit our website, and you can download more detailed publications which cover the New Zealand market, and indeed you can contact Zoltan direct for more information. Do bear in mind that if you've enjoyed this presentation, there are many more podcasts, presentations, and videocasts available via CBRE's website and various other sources. Thank you for joining us, and we'll hope to speak to you again soon.